In this video, I am going to be covering some more of the basics that you'll need to know for your life and health or your health insurance exam. So I'm going to share my screen here. I'm going to be going over some vocabulary words with you all so that you can understand some more of the basic concepts and vocabulary that you're going to encounter on your life and health or health insurance exam. If you find value in this, click the link in the description of the video for a free study guide on this material. And if you would be interested in working with me, send me an email or click the link in the description of the video. My email's in the description as well. So first things first, health and accident insurance claims. So the responsibilities of a health, what I'm going to do, I'm going to read the material and then I'm going to summarize it and try to put it in a way that might help you remember it better if there are ways that we can do that with what's spoken. So the responsibilities of a health insurance claims examiner differ somewhat from those of a life insurance claims examiner due to the complexity of health insurance claims. Okay, so life insurance is really straightforward, right? So this is what it's saying. Life insurance is a really straightforward claim. Did the person die or not? Health insurance, there are a lot more complications. So because one, medical expense insurance or health insurance, another name for it, it operates on a reimbursement basis. So that means that the amount paid is not predetermined, but based on the actual loss incurred. So when you die for a life insurance policy, the benefit is set, right? Like the individual knows exactly what the benefit is going to be. For a health insurance policy, the benefit could be to cover a claim or cover a procedure or cover care, but the cost of that care may vary, right? So the amount paid out by the insurance company is going to vary based on the claim. Life insurance, the claim is filed, it's a set amount paid out. The insured is reimbursed for covered medical expenses up to policy limits. So essentially, the basics of it, the person who is insured pays the claim, and then pays the fee, and then the insurance company reimburses them once the claim is filed. Most health and medical expense insurance companies, though, bypass that whole thing, and they will settle the claim directly with the healthcare provider to just bypass having to reimburse the individual because it's so crazy expensive, right? I mean, imagine you go to the hospital and it's a $100,000 procedure. It's not like you can come out of pocket for that. Most people can't, and then get reimbursed for it. So these reimbursements are generally exempt from taxes because they're meant to restore the insured to the financial position they had before the loss. So they're tax exempt, meaning the benefits paid out, the reimbursements are not taxable because the insured isn't really gaining anything. They're just getting back to where they were before they got sick or injured or whatever. Now, valued contracts like life insurance, accidental death and dismemberment, and disability income are different because they pay a fixed amount defined in the policy when an event like death or disability happens. So like I was saying, for life insurance and disability insurance, or accidental death and dismemberment, when someone has the issue happen, there's, when the claim is filed, there's a specific amount paid out. Life insurance is a death benefit. It's exactly what it says on the policy, a certain amount. Accidental death and dismemberment, same thing. It's a predetermined amount. It's a predetermined value. And disability income as well, predetermined value of what they're going to receive if they're disabled. So for health insurance, the claims examiner must verify whether the loss has occurred. This is difficult in disability income cases where determining whether the insured is truly disabled can be subjective and lead to potential misunderstandings. And then finally, the assignment, I was talking about this before, the assignment of benefits directly to healthcare providers makes the claims process more convenient for the insured because it simplifies the handling of accident and health insurance claims. So, right, because it's like, okay, are they really disabled? So that's why filing the claims examiner, the job's difficult for disability because they don't know. Someone could fake it. Someone may think they're disabled and they're not, or someone could be very disabled and the company might try to say they're not. And then this is the assignment of benefits where the carrier, the health insurance company, will pay the benefit directly to the healthcare provider. So it's easier. Okay, reserves. Insurance companies allocate reserves for future claim payments, known as unpaid claim reserves. A portion of each premium is allocated to reserves, referred to as unearned premium reserves. So reserves is just a pool of money that the insurance company has to pay claims if there is, it's just like backup cash that they have in the bank to pay a claim. So reserves is money that they have on reserve to pay unexpected claims and things like that. Additionally, a portion of each premium, so when someone pays their health insurance premium, a portion of that premium goes towards reserves. Okay, subrogation. This is the insurer's legal right to seek reimbursement from a third party responsible for causing a loss covered by the insurance policy. By doing this, the insurer seeks to recover the amount it paid out to the insured as a result of the loss. So for instance, say someone goes to the hospital for a broken arm, and they have to get a procedure to fix their arm. If someone broke their arm, the insurance company could go after them with subrogation to seek reimbursement for that. Because they're like, hey, we wouldn't have had to pay this claim unless you broke this person's arm. Loss of coverage. Losing minimum essential coverage is generally considered a qualifying event which can trigger a special enrollment period. So during this period, the individual has the opportunity to enroll in a new health plan, either through the marketplace, exchange, or outside of it. Several situations may result in the termination of an insurance plan. The insurer leaves the marketplace, you leave your job and lose group health coverage, or divorce, illegal separation, or death. So when you lose coverage, it'll trigger a special enrollment period, which allows you to obtain a new health insurance plan without a coverage gap. So if you leave the marketplace or leave your job and lose group health or go through a divorce or legal separation or death, now the insurer leaves the marketplace. That's what this means. So say you are covered by ABC Insurance Company, and they are like, hey, we're no longer going to provide policies in the marketplace, then we're not going to renew your policy. Then you're kind of stuck. You have to get a new plan. So what this special enrollment period allows you to do is enroll in a new plan without any gaps between coverage. Or if you lose your job and lose group health coverage. So if you work for an employer that provides health insurance to you and then you leave, you have a special enrollment period kicks in to allow you to get a new policy through the marketplace, or if you go through a divorce or separation, or you die. I mean, if someone dies, not if you die, you don't need health insurance. Okay. ACA compliant, is Affordable Care Act. Okay, so this is health plans have to be compliant to the ACA, which we'll get into another video. Okay, uses of health insurance. Individuals and businesses both rely on health insurance to safeguard against the financial risks associated with illness, injury, or disability. So individuals, a comprehensive health insurance plan is essential to protect against the potential financial burden of medical care or disability, right? You need a plan to protect against getting really sick or getting hurt or disabled. And then health insurance is helpful for business for managing risks, right? To make sure that they keep their employees healthy. And it also incentivizes employees to stay with them. So a good health insurance program, typically, we're not going to go over that. Okay, we're going to go next part. Balancing cost and average. So when choosing health insurance, cost is a major consideration for most policyholders, okay? Often they have to choose between assuming more risk for lower premiums or paying higher premiums for more comprehensive coverage. So, for instance, a health plan with a $250 deductible, we cover deductibles in Basic Concepts video 1. An individual health plan with a $250 deductible will generally be more expensive than a similar plan with a $1,000 deductible, right? Because the insurance company, the insured is only liable for the $250 at the visit, whereas anything over that, the insurance company has to pay. Whereas with the $1,000 deductible, the insured has to pay more when they go for care. So if you have to pay more when you go for care, then typically your premiums will be lower. If you have to pay less when you go for care, typically your premiums will be higher. Same thing here. So a plan feature 80-20 coinsurance will cost more than one with a 70-30 coinsurance structure. So this means the insurance company covers 80%, the insured covers 20% of the care. That's going to cost more than the insurance company having to cover 70%, right? The premiums, right? So this is premiums we're talking about. Okay. Premiums are more expensive if the insurance company is responsible for more care. All right. The important question they need to consider is, am I willing to take on more of the potential cost for future claims in return for the guaranteed savings that come with a plan that has a higher deductible or coinsurance rate? Okay. Okay. Disability income insurance needs. Protecting one's earnings through disability income insurance is a critical yet overlooked component of financial planning. So essentially, people become disabled, they can't work, they can't make money, they need coverage to make sure that if they can't work because of a disability, they still have money coming in. Okay. Those who do not have disability income insurance are effectively self-insuring. So they're vulnerable to financial hardship if they're unable to work. Okay, so if someone doesn't have disability insurance, they might be putting themselves in a tough spot. They're very vulnerable to what happens if they are disabled. Many people believe Social Security will provide income if they're disabled, but Social Security's definition of disabled is very strict, and the benefits may not be enough to meet the individual's needs. So, Social Security is super strict. Like, I have a friend who is definitely 100% disabled, and it was very hard for him to qualify for Social Security disability benefits, even though he's got a real disability, right? They should be viewed as supplementary income, not as a primary safety net. So someone should get a personal disability income plan for the main source of income protection in the event of a disability. They should not rely on Social Security. Okay. Now, managing costs for disability income plans. Policyholders can reduce the premium costs of a disability income plan by adjusting two factors. So the elimination period, so a longer elimination period lowers premiums, and the length of the benefit period. So a longer elimination period means it's longer time before the benefits kick in. The elimination period is the time between the disability starts to when benefits start to kick in. So if that time is longer, premiums are lower. If that time is shorter, premiums are higher. Because if that time is shorter, that means the insurance company is going to have to start paying out claims faster. And there's less time for the person to heal and not have the disability anymore. And then the benefit period. So if the length of time benefits are paid out directly impacts premium costs. So if the benefit period is longer, then it's going to cost more. If the benefit period is less, it means they're going to have to pay out those disability benefits for less amount of time, which means the premium will be lower because the insurance company is not liable for as much money. So because individually funded disability income policies receive favorable tax treatment, a plan that provides around 60% of pre-disability gross earnings is generally sufficient. This is due to the fact that disability income benefits are exempt from income tax when the insured person is responsible for paying the premiums. So example, individual earns $3,500 a month, but takes home $2,300 after taxes. A tax-free disability benefit of $2,100 would likely be enough to cover living expenses. Okay, that's 60% of the total amount. It's because the disability benefit is not taxed. Okay, so if the $3,500 under most circumstances. So the $3,500 after tax is about $2,300. So if they get a tax-free $2,100, that's pretty close to the same. Okay. If the insured has additional income sources, part of the benefits may be subject to federal income tax. Okay. A lot of people don't have other sources, but if they do, part of that benefit might be subject to federal income tax. Okay. So we're going to cover, okay. So preventing malingering and false disability claims. So malingering is like when you lie or like exaggerate. So we're going to go here. It's to exaggerate or feign illness in order to escape duty or work. So to malinger is to fake being sick. Like when we used to say we were sick to go to school and you weren't really always sick, but a lot of times we were, but sometimes, we'd all fib a little bit. That's malingering. Okay. So to prevent that, insurers impose limits on the total benefits an insured can receive from two disability policies issued by the same company. Okay. So ensures that there's limits on the total benefits that can be received. All right. If there's two policies. All right. So group disability plans. For group disability income plans, the participant typically has sorry if you guys hear noise, they're installing solar where I am. So for group disability income plans, the participant typically has limited control over the benefit level. So the plan document has a schedule of benefits outlining what the participant is entitled to in the event of a disability. All right. So for a group plan, the participant doesn't control much of the benefit, but there is a schedule of benefits letting them know what they're eligible for. And then in families where both parents are employed, it's important for disability income insurance to be considered for both parents, because if either income stream is lost, then obviously that could really, really hurt the family. So I hope this helps you guys with your health insurance exam or life and health insurance exam studying. Keep watching more of my videos. You want to watch this next video coming up because this is an essential for passing your exam.